So thanks everyone for coming along today on well, it's afternoon for me, California morning, but Thursday coming up to next week of not much happening coming up to Christmas. So appreciate you guys joining us and hopefully learn something along the way and actually timely for end of year credits for a number of different designations. Looking at a couple of the names there, one person's been on 3 presentations of mine in 3 days. So someone obviously the credits end of the year. So thanks for joining us. Just a couple of housekeeping things on that is if you are here for credits, then please do stay on for the full amount of time. If you jump off before, we have to send to the board spreadsheets showing attendance times and stuff, and no one wants to have an awkward conversation when someone's jumped off after 36 minutes. So please do stay on for that and email myself or get in touch with whomever invited you to let them know your number and that you want credits filed. One other thing in housekeeping is we have the Q&A bar. So please don't feel like you have to wait until the end. If you have questions as we go along, type that in and we'll stop and interrupt if it's something that is kind of timely there, or we'll keep it to the end, but we'll keep our eye on the bar as we go along. So today, talking about non-equity real estate, and this is specific to mortgage notes as an investment vehicle, something that I knew about conceptually, but didn't know a huge amount about until I met Lauren a few months ago at a conference. So we'll be digging into that today, particularly how it relates to this current environment where equity in real estate has certainly got some challenges and people are considering other options in real estate from an investment point of view. Disclaimers here. I'll pause for a second. I'm not going to read all of this because my voice will be done before we even get started, but let me pause for a sec and you guys can just take a look down that. The most important thing being that this is an educational presentation. This is not kind of any offer, any solicitation, or anything that's product specific. This is educational in nature. And as we said about the CE, we're approved for 1 CE CFP credit, and it's hot off the press, Investments and Wealth Institute. So the SEMA and others for investments and wealth approved for those as well. And just worth mentioning is, I know that some of the designations actually have, let's call it non-specific learning. So if you've attended something educational, you can log it, even though it doesn't need to be approved by that specific board. So that is something that normally we are eligible for as well if you've got other designations with non-specific. Okay, let's just take a minute now to do the introduction. So this is me, Richard Hillson, Hillson Consulting. Essentially, the mission statement is that we believe that alternative investments are misunderstood, underrepresented, and need to form a part of every portfolio. How do we fix that? And the answer is normally one advisor, one client at a time, and predominantly through education. I'm sure we're all familiar with this, the issues that come with such a broad terminology when it comes to alternatives. It's easier to say what's not an alternative investment rather than what is an alternative investment. And therefore, I personally was getting incredibly frustrated with speaking with advisors and clients who, oh, alternatives, that's like Bobby Axelrod from Billions, that's a black box hedge fund trading strategy, or that's crypto or something high octane. And although both of those are a very small part and at a very extreme end of the alt spectrum, alts typically tend to be lower volatile than some equity plays, can be predictable real estate, can be a number of other things. And this broad classification does us all a disservice and causes problems in the understanding, the communication, dealing with clients. So with that said, anything I can do to actually further the alts cause, whether it be working with advisors, brokers, their clients, and equally working on the sponsor side to help connect the dots and help educate and do some hand-holding with the audience. Anything that furthers the alts cause is in my wheelhouse. I'll hand over to Chris and Lauren now to introduce themselves and just give us a brief introduction to their company.
Thanks, Richard, again for coordinating all this and bringing us here today. I am Lauren and this is Chris. We are the co-founders of CWS Investments. Really behind our mission is to bring a relatable asset class that is otherwise not talked about to the masses. And how we do this is through education like this. And what we do is we invest in first position mortgage notes throughout the US that are secured by single family homes with equity. And we like to say that we fix and flip mortgage notes while working with borrowers to stay in their home. So we'll get a little more into the details later, but a little bit more backstory on Chris and I. We probably were sitting in your client's shoes, maybe anywhere from 10 to 25 years ago, and looking for a different way to diversify our portfolios. And real estate, is always top of mind for most people. But what's a different way to do that than having to actually own a home? And we really kind of both branched into this with our, own capital, kind of building our own portfolios in this asset class, which you might, like Richard said, you might have heard about it in theory, but what does that look like in practice? So a big part of what we do is not only, the education behind it, because really it is a very easy concept to understand once you understand it. And we think it is an accessible option for the masses.
Cool. Okay, so let's start with this crash course right at the top is overview of the mortgage note industry. And I guess the first thing which I'm sure you'll cover it, but the first thing that would come to my mind from a client's point of view or an advisor's point of view, which if you could dig into that a little bit, is as soon as people hear about mortgage notes or anything related to that, is I get it. There's this visceral reaction because of 2007-8. And so before we kind of address anything else, let's kind of touch on that and the elephant in the room, which is this anything like the types of securities where everyone got burnt to some degree, directly or indirectly, back in that period?
So 2008 was a very unique animal that existed, and many believe we'll probably never see anything like that again because there was a lot of turmoil, but there was also a lot of fraud that went on during that time. And the mortgage market has learned considerably, and the government has learned a lot during that time. Since that time, we've had the creation of Dodd-Frank, the creation of the Consumer Finance Protection Bureau, really a lot of implementations in place to protect more of those homeowners from getting taken by having loans they couldn't afford, or banks, how they are underwriting their assets. So you had two components where you had the banks, which were not properly, or some may not have been properly showing things on their balance sheet, and then borrowers who are mortgage originators who originate these loans didn't have to be licensed. They would have somebody give them a loan. I had a personal experience where I had somebody try and give me at the time, a $500,000 loan that was interest only, that would shoot up. That I'm looking at numbers and I'm like, in a year from now, my take home couldn't even pay the mortgage, and they're trying to tell me I could afford that. So, so to answer that question, Richard, it's very different environment than it was 15 years ago.
Yeah. And I'll just add to that, just the market as well is very different. So back in 2008, equity wasn't there. Borrowers have a ton of equity. Borrowers back then were walking away from their homes, filing for bankruptcy. Right now, there's no inventory of homes available. And again, back then, people could walk away and find another home to rent. Whereas now you have rent rates that have increased. So when it comes to kind of what we do, we're seeing more borrowers willing to come to the table because they're not able to afford to rent somewhere else, or really, quite frankly, can't find somewhere else to rent. And their mortgage at the interest rate of, probably anywhere from 3 to 5% is significantly less than what they would pay to rent something else. So again, it in a way is significantly different, not in terms of borrower motivation, but the market in general.
And so we are talking about, when we just from a definitional, that mortgage notes are essentially individual mortgages acquired from strict compartmentalized lenders who, you know, if it doesn't check a box, as opposed to more flexible, in the same way that businesses might get bridge financing kind of thing for interim periods. So, I mean, it's as simple as residential mortgages being acquired, right?
Yeah. So the way I like to describe it is, if anyone listening has ever owned a home and you've received a letter in the mail from the bank that says, hey, we're no longer your, you know, lender of record, your new payment needs to go. Say you were with Chase, it's going to go now to Bank of America. Please start sending your payments there starting, you know, October or January 1 in this case. That's what we do. We are the people sending the letter out saying, hey, your loan is no longer with JP Morgan. CWS Investments is now the lien holder. Please send all future payments to here, this servicer. So I think that resonates with a lot of people and kind of what we're doing. We're not going out and, you know, these aren't huge buckets of assets that we're, say, taking 1,000 at a time, and kind of we're really cherry picking versus buying in those tranche of loans, which again is very different from what we were seeing in 2008.
Yeah. Okay, so talk us through the process here.
Go ahead, Chris.
So, you know, what is mortgage note investing? And it's interesting because I had been in real estate 25 years and I didn't know this existed until it popped up. And this is, like you mentioned, getting people into alts and understanding that there's a lot of options out there. And, you know, to simplify mortgage note investing, it is just an alternative investment strategy where loans get sold on the secondary market from private lenders, banks, credit unions, you know, anyone that holds debt. And typically it will get sold at a discount depending upon how good that paper is. And then whoever buys that loan will eventually just be able to collect those interests and has that security against the property that gives them certain rights if the borrower were to ever go into any type of default.
And so, yes, this is a pooled vehicle because there will be numerous different notes within this that someone would buy a fractional interest in. But again, to get us away from the 2008, 2007 to 2008 PTSD situations, the pooling there was not to make a vehicle. It was actually pooling a load of subpar individual holdings, because supposedly it's easier to get a classification by putting 1,000 pieces of rubbish together rather than just individually. So as soon as people say kind of pooled or whatever, you immediately think that, but this is cherry picked individual circumstance put together into a fund for investment purposes.
Yeah. And Richard, I'll just mention, like 2008, a lot of that was, and this is different than mortgage-backed securities. You know, mortgage-backed securities are something very different than, like you said, those get securitized and pooled and then you get sold on Wall Street. And in 2008, they were giving very high ratings that these are really good loans, and come to find out they weren't. And that's what caused, you know, anyone seen the movie The Big Short? That's what caused that to happen. And like I said, this is a very different investment strategy.
Okay. So let's talk about this performing versus non-performing classification in this space.
Yeah. So like Chris mentioned in the last slide, when we are purchasing these at a discount from the seller, and we'll talk about seller motivation here in a second, you know, they're kind of marked based on, you know, value. What's the value of the loan? And these are the main two categories that they fall into. So you have performing, which is, you know, a borrower is meeting the terms of their payment, paying their mortgage every month on time as expected. And typically when you're purchasing those, it's anywhere from 60 to 90% of the outstanding balance that you can acquire those for. Then we move into non-performing, which is anywhere where a borrower is delinquent 90 days or more and isn't on track per the terms of their agreement. So they're not making payments anywhere from 90 days or more. So typically you can get, acquire those loans for anywhere from 40 to 60% of the outstanding loan balance. So when we're looking at these tapes, which is really a glorified Excel spreadsheet of assets, and cherry picking, which ones fit our criteria, we're looking at performing, we're looking at non-performing, and then there's the gray area in between, which is reperforming, of people who might have been non-performing that are now performing again for whatever reason. So that is those are the two categories that we look at when we're looking to bid and acquire assets.
And so, yeah, let's talk about this current environment and I think one of the, from a broader picture, how we got here is that certainly one of the biggest questions that I'm asked at the moment from any advisors that I'm working with or just in conversation with advisors is if their clients are perhaps not adventurous enough to move away from real estate, because I've called REITs the gateway drug affectionately for ages, is that if someone decides they want to go into alts and they've got clients who are not ready to get into anything too complicated so far, or they've put up that brick wall like we talked about earlier because they think alts has to mean crazy high octane things, is real estate is normally a pretty good starting point. And the starting point would be REITs or equity side of real estate. And at the moment, multifamily seems to be like, it's not quite what it used to be a couple of years ago when 90% of presenters at the conferences were multifamily, but that's a pretty easy starting point. Now people are saying, well, I'm not sure I want to have the equity exposure in real estate, but I'm not quite ready to venture into more what they would deem to be more exotic areas, private equity, private credit, other things like that in the alts universe. So what kind of fascinated me here was that we're still in real estate, which is quite a comfort zone for a lot of people, but we're just looking at a different profile, which is the debt side of real estate rather than the equity. So we're staying within what most clients are most comfortable with, yet giving a different type of return profile and a different type of risk profile. So just to premise kind of what we're going to talk about now is that is the macro kind of conversation that I've been having with a lot of people about. In this environment, I need to look at other things other than just the most basic real estate equity. What else is there? And I think that this sits really nicely and complements in this current environment.
So great comments, Richard. And you'll see popping up online all over the place, a lot of the larger hedge funds getting into private credit. They're getting into that debt side because, like you mentioned, REITs, multifamily, they're getting significantly impacted by these the mortgage rates, these interest rates. And as these interest rates climb, it impacts their NOI and their debt service. So it impacts, of course, those investor returns. And most people will think, well, isn't that the same case in private credit? Well, if you're originating loans, like, most people will think, Silicon Valley Bank, might have had loans that originate at 3% and they now are selling them at 7%. That could have an impact. But when you're buying on the secondary market, you're targeting a yield return. So you're discounting it to hit that specific yield. So interest rate correlation is small to minimal to almost zero in that sense. So and when you look at where most people see the headwinds of the economy going right now, with inflation, everything's getting more expensive. And now people are starting to get insurance and tax bills, especially in Texas, California, and Florida, that, are just mind blowing. People having trouble affording their mortgage. And we're starting to see more defaults, which through, like, you go back to 2008, after 2008, it was pretty steady of, the number of defaults anywhere from 2 to 5% of mortgages. During COVID, of course, that went down significantly because of government intervention. Now it's starting to tick back up, in that sense. And where things are headed are, again, with these higher defaults, it gives opportunities for alternative funds to invest in this asset class and understand that borrowers are going to try and want to stay in their properties because, as Lauren mentioned earlier, they have no place to go. Your credit might take a hit. Rents are more expensive. Still, most people still bought their homes back in 2010, 12, 14. So they have that significant equity pop as well. And they don't want to lose that or get a house that, is an extremely high rate. So because of that, it also then looks at this play of these older loans have so much equity in them. You look at the risk of if housing prices do come down and your mortgage balance is low, it's not really going to have much impact on that loan. The biggest impact typically is jobs, is what correlates most with most, people. If we all own a house and my house goes up or down a small amount in value, not going to change whether or not I pay my mortgage. What's the thing that impacts that the most? So
yeah. And I want to add that one question we get a lot from people who, are looking at this asset class and kind of learning more about it is, well, what's the market like? What's the inventory you're seeing? And you saw, the slide deck earlier with what the size of the market being massive. Okay, well, what are you seeing? Well, like Chris mentioned, we're seeing more defaults throughout 2023. And to kind of show you the increase or kind of explain and paint a picture of what that increase in inventory looks like for us is, first quarter, 300 million in loans across our desk. Second quarter, 300 million a month in loans to evaluate. Third and fourth, we're looking at about 300 million a week in loans across our desk. And what that does is it gives a ability for pricing to soften in what we're acquiring these assets for, and us to be more picky on what specific loans we are taking on. So, and not just us, anyone looking to acquire assets, So again, it's simple supply and demand, and the supply is very different from what it was, during COVID, like Chris said, where there was government intervention, people couldn't really work with borrowers as easily. But again, there was a whole different pro to that, is that everyone was refinancing at the time. So payoffs were abundant. So again, this asset class typically does well in a downturn market.
So let's talk about what motivates sellers is if they're selling them for between what it sounded like 40 to 90%, depending on whether it's performing or non-performing, is if this is something that can be monetized and actually an investment going forward, why is anyone selling this?
Yeah, and really boils down to banks want to get these off their books for multiple reasons. One is how they have to now report them in regards to on their balance sheets, because it hurts their pockets once a loan goes non-performing. But more importantly, banks aren't staffed to manage a significant amount of distress. Now, we like to use the example of, think of a car manufacturer. These loans and the payments coming in is like a car on the assembly line. It's a nice, smooth process, but anytime something happens and it gets kicked off of that assembly line, a lot of people have to get involved and things have to happen, and then they're out of their rhythm and it causes a lot of chaos. If anyone's had to ever, deal with, banks on many different things, I had to go in one time just to close an account, and you have to get 4 different approvals to close an account, with a bank. Imagine how many approvals it is to get a borrower to change their mortgage payment or give them any type of modification. The banks, there's a lot of red tape that they have to cut through to get to there. And with a lot of these alternative funds out there, they can make that decision instantaneously. They don't have to go through 27 departments to get any type of approval. And then the other is also, during high interest rate periods, if a bank had a loan that was it, 4 or 5% originated and it's defaulted, they can write a loan today at 8% with an $800 credit score, 800 credit score on that borrower. Common sense would say, let's get rid of this and go use that money on this other borrower. So that's what main reason why banks sell. And I'll let Lauren talk a little bit about the lender side of things.
Yeah. So when it comes to lenders looking to sell, like, for example, we mentioned our strategy is to fix and flip mortgage notes. So that flip part would be selling back on the secondary market. Well, why would people do that? It could be to rebalance their portfolio. Their fund is closing. They're it doesn't fit their buy box any longer. So for example, if a fund takes down a larger tape of loans that has loans that are non-performing and they only do performing, they would seek to liquidate those non-performing to a fund that does handle non-performing. It could be it doesn't fit their buy box by state or lien type, first position versus second position. So there's a variety of reasons lenders would look to sell back on the secondary market.
Lauren, a question came in for you. Did you see that on your Q&A bar?
Let me see. When looking back to 2008, 2009, do you have numbers to compare? For example, Lauren gave for 2023 of 300 million in Q1, Q2 and Q3 per week. Is this a multiple less or above compared to 2008, 2009?
This would be it's a multiple less from 2008, 2009. Now, there's multiple factors. The overall mortgage market back in 2008, 2009 wasn't what it is today, because of valuations and the number of homes. But if you look at it from a percentage basis, which is probably a little bit of more accurate on where we're at in each cycle, 2000, it's really 2008 to 2011 is really what that turn was. And we peaked at about a roughly 9% default rate. And today we're floating at, a 2.5% to 3% default rate. Historically, you're typically going to be between a 2.5% and 5% default rate. So clearly 15 years ago, significantly higher than any other period.
And I had a couple of questions to kind of dig into here about this. Is that we've used the term distressed a couple of times, and actually, Lauren, you and I were speaking about this earlier this week. Is distressed is kind of a double-edged sword with the terminology and a number of other things. Is that sometimes you say distressed and it actually kind of spooks investors, whereas I get excited with that because I think opportunity. And so, but there's also very different types of distressed. Is the analogy that when I speak about this with people, is the analogy that I sometimes use would be, think distressed real estate might be buying a pretty rundown residential property on the edge of gentrification. So in an area that is not necessarily desirable, might be along the line, and that property needs a significant investment, capital investment, to bring it up to a point where it could be flipped. So the buy, renovate, flip kind of strategy. That is, I think, what most people think of as distressed, needing capital, potentially risky because it's not necessarily desirable. And then the other side of that would be a company buys their competitor who are having a short-term cash pinch, but not a fundamental long-term problem, and they can pick up their competitor just because of circumstance and opportunity. That would also be a distressed asset, but it feels very different. So that's the kind of two sides that come to my mind when I'm talking through this. And I think some people perhaps shirk away from distressed because of the terminology, whereas actually I maybe a better terminology is opportunistic. So can you just talk about that? Is that the loans that you're acquiring might not be distressed in the sense that no one wants them and they need huge effort to turn around, but they might be more circumstantial.
Yeah, that's a great point. So I think really going back to like what the definition of distressed is in this asset class would be important. So when we say distress, we're not talking about the property itself. We're not talking about a rundown property on, in a place no one wants to live. We're talking about a distressed loan. So something caused a borrower to be in a distressed situation where they can no longer meet their financial obligations. Now, the really big difference here, and kind of goes back to what Chris said, is banks are notoriously inflexible, and we're really filling that gap. So these loans, these borrowers just need restructuring. They just need someone who is going to work with them to get them back on track. And again, it's kind of us filling that gap where banks are more inflexible, not really willing to work with borrowers, which is why they typically sell them at such a discount. We're coming in, we are kind of creating that win-win solution where we're able to work with the borrower, and, create a opportunity for people to get in on an asset class that is typically, not available to the masses.
And that's a perfect segue as to why someone might be distressed in the broad use of that is because I'm sure everyone here, we all grumble about outsourced overseas call centers and the fact that everything's algorithmic with banks and everything now is it was probably slightly before my time, but my dad will always get on a Sunday afternoon rant about when he used to play golf with the bank manager and that deals were done about real circumstances, real relationships, and actually knowing your client, as opposed to someone might not check these boxes, but okay, that's a computer deciding rather than any kind of human judgment element here. So don't get me started. I'm turning into my dad here with a
yeah, Richard, kind of like saying that is like Lauren mentioned with the banks and inflexible. It's, the loans we see, some of them, it's like, seeing the movie Groundhog Day, where a borrower is behind by a few payments. They look to get the loan, worked with the bank. The bank takes 2 months to get back to them. Actually, we'll talk about this. Actually, we have a slide coming up. I'll talk more about it on that slide.
Yeah. Okay. There we go.
There we go. So what causes these borrowers to be distressed? Really, I think this is probably the biggest hurdle and educational point that we have to hit home with when we talk with people about this asset class, because I grew up thinking if you missed your mortgage payment, the bank is taking your home, overnight. And so you think, okay, well, if people aren't making their mortgage payment, did they just wake up one day and say, today's the day, this is the month, I'm not going to make it? We've done over 700 different transactions. We've worked with over 700 loans. We've been doing this just under a decade. And for about 95% of our portfolio, what we're actually seeing is it comes down to these 4 reasons. We see in the servicing notes when we're evaluating these assets that it's either job loss, health, divorce, a death in the family, that is this kind of situation or, big life circumstance that pops up that causes them to get off track. And that then creates kind of this snowball effect because we go back to banks being inflexible. So for example, someone loses their job, and this has happened, more times than I can count on both hands since we've been doing this, where someone loses their job, they get behind, say 3 months on their mortgage payment, they get a new job, they go to the bank to make a payment, and the bank says, well, that's great, but we're going to have to collect late fees, interest, and you have to make the prior payments before we can start putting any of your current payments towards, your current due. Well, it kind of snowballs up for them because by the time they're able to do that, it's been 6 months. So now they're 6 months behind plus late fees. And there's no way for them to get rid of that snowball. I don't know how a better terminology there, but so that's kind of where we come in, and what we do differently to fill that gap is we'll work with that borrower. We'll say, okay, we clearly see you lost your job. You have the financial, now you have the new contract from your current job. You've provided the financial package to us that says you can make your monthly payments. We're going to put you on a trial payment plan for 6 months to meet those monthly payments. And then we'll work out a payment plan for the arrears. We'll extend your term. So we're not touching interest rate. We're working with the arrears to see how we can work with the borrower to come to some sort of agreement to get them back on track.
Yeah. And that's what I was going to say, Lauren. I was just one slide earlier. So, but with that being the case, I mean, I joke about, but it is like Groundhog Day. And I had one borrower tell me, I feel like I'm pushing on a rope with some of these banks because it's like you can't get anywhere with anyone and they get the runaround. And eventually what happens is the banks also give up and just stick it in a file and just continues to get that borrower behind. And it's very unfortunate because of, a lot of this stuff could have been worked out ahead of time, but it goes back to that inflexibility with some of these lenders.
Yeah. Okay. No, that makes a lot of sense. Okay. So let's talk about this. We alluded earlier to the fact that a lot of people are looking at what are different return profiles while staying within real estate. And actually, when I said earlier about some people not wanting to venture into private credit, it's a step too far at the moment for them. Is we'd be talking the private credit, which is kind of like lending to small mid companies kind of thing, secured against inventory or whatever. Is we're staying in real estate here. So let's talk about that debt versus equity situation here, where some people are looking for different types of return and risk profiles while still having their foot in real estate.
Yep. So as you mentioned, there's those two different risk profiles, the debt versus the equity. And, each investor may have their own preference, and they really have to understand, the capital stack and where they line up on that capital stack. Because on the capital stack, debt is typically, in a first position, and might get paid off first, and secured to that asset, which again, sometimes it can be secured, but a lot of times in most instances, it's unsecured. And when it's unsecured, you're at a much higher risk. There's funds out there that have investors that tie it to like a limited rights obligation or some type of other unsecured debt. And you really need to understand where you are in that capital stack. On the other side of things with the equity, there's some security within that asset, as well as once you're secured, usually a lower risk profile. And also, when it is a pooled assets, it also gets spread across many different asset classes compared to if you're on an individual investment. So, Lauren, anything you want to add to that?
No, I think you covered it, really.
Okay, so let's talk about, and there's a whole separate conversation about the old 60-40 and the fact that historically investors who were taking alts allocation would take their alts allocation from the equity 60 rather than spread, depending on the different type of characteristic of the alternative. But as a yield play, how does this fit in the current environment?
Yeah, and this is, as Lauren mentioned earlier, a question we get asked a lot is how do that interest rate environment impact, a lot of these funds? And on the secondary market, you're buying based off of a specific yield. And I'm just going to keep it very simple with numbers. If you're targeting a 10% yield and the current loan is at a 3% rate, and you have another loan at a 5% rate, well, that loan at a 3% rate is going to be discounted greater because of the spread difference between that and the 5%. So that's why in many instances, it's that interest rate agnostic, because you're just going after that targeted return. So if rates, on that asset increase, it just might sell, the paper might sell at less of a discount to achieve that yield spread for that investment firm. And again, that's very different from a lot of these other asset classes that you're seeing out there today that are getting severely compressed because of the interest rates. And most people who invest in debt, they're not taking on that debt, so they don't have a fluctuating variable rate on the side that can impact their pro forma, where most other types of asset classes in real estate, they're debt driven, where might be 40 to 70% of that asset is tied to debt. So it has such a lot more sensitivity to any rise in interest rates.
And so that also moves into the area of how you generate the return, because this isn't like private credit where you're doing bridge loans at 15% and that's where you make the investor money. Is my understanding here is that yes, there's the interest rate and so the repayments and things like that, but actually it's because you are acquiring these assets at a significant discount. That's where you generate that incremental return, right? Yep.
Yeah, there's two places, and I think we talk about it a little further. Where if you bifurcated the returns, you get, if it's reperforming or performing, you'll get that cash flow, and then upon exit, of course, you have incremental at that exit as well, because when you, like Lauren mentioned earlier, it's like fix and flipping loans. When you think of a house that you go in, you rehab the house, it increases its value. By doing that with the borrower, we're increasing the value of that loan because we got that borrower back on that payment plan.
Yep, yep, that makes sense. Okay, so we've talked a bit about the opportunity in this market, but why now?
Lauren, do you want to grab this one?
Yeah, similar to what we talked about earlier, why now? We're seeing more and more default. The government intervention has dried up, loan payments are due. Inflation has caused cost of living to skyrocket. And so people are starting to struggle with making their mortgage payments. And we're seeing that through the inventory that we're seeing come across our desk. And so there's more opportunity to cherry pick, get more quality loans that we know we can work with the borrower. And so, yeah, that's really kind of, I don't know if Chris, you have anything to add?
Yeah. It's really now starting to see that, I'll say that perfect storm, like Lauren mentioned. You got foreclosures on the rise, inflation, a majority of Americans who live paycheck to paycheck. And as things increase, we're just starting to see more distress coming. And, within the distress, and distressed borrowers, there's more non-performing loans that come out.
Yeah. And then, I mean, like the slide says, but some term that I'm not really, I feel like it's said as a box checking thing in the alts industry is it's not correlated to non-correlated asset class. And I know that's one of those, again, boxes I feel like I have to check, but in this case, truly, interest rate agnostic, not correlated to the private markets, and something that provides an income to investors during this time to kind of diversify their portfolio.
Also not correlated to stock market either.
Yep. Yep.
Okay, and just to expand on what you've just said is what next stage of why this?
Yeah. So again, if you drive through any major city, who's typically the biggest, owns the largest building, is a bank or a lender. And when you look at it, it's passive cash flow, and you don't deal with the headaches of, we like to say termites, toilets, or termites. If you're own somebody's loan and they have a roof leak, well, you don't call your lender, you call a roof person. If you're the landlord, you're getting that phone call. So it's just a very different asset management class. And as we've talked about on the prior slides, it can be profitable in any market condition. It's because it's not correlated to interest rates, stock market, housing pricing. Yes, does have some correlation, of course, and really it's more correlated to jobs market. But typically, when there is a significant downturn in jobs, it just means there's increased number of loans, which means more opportunity. The other is just collateral. It's collateral backed. You're secured by real estate. So it's not, like you mentioned, private credit giving somebody money for inventory for a business or equipment or things like that. It's real estate is that asset class. And then the versatility. Being the lender gives you a significant number of exit strategies with every asset, especially if you are not taking on any debt, any leverage within a portfolio as well. It always gives them maximum versatility and flexibility.
Yeah. And just kind of to add to that is kind of taking a step back and looking at this through the lens of me 10, 15 years ago is, okay, it's real estate. I like that. I can understand what it is because I can understand the concept of a loan and a bank and being a borrower. So I'm investing in something that I understand and is not owning the property, like Chris said. It is becoming the bank. So it's an asset class that's easy to understand. You're mitigating your risk amongst the pooled assets. And then really the exit strategies, if I'm looking at this again, I would say, okay, are they tied to one exit strategy? And that is another thing to me that makes us attractive is, the way we work with borrowers is not a one size fits all. Again, it comes back to that flexibility and filling that gap, but also say, it is collateralized by the real estate. So we do have the option to take the property back. We do have the option to do a deed in lieu with the borrower if they want to walk away from the property. We can, push the arrears. We can work with them on a payment plan. So it's not tied to one exit strategy, and you're not tied to one asset as well.
Okay. Let's have a little look at the how this works as an investment. And we've covered a lot of this already, but
yeah. So I'll just walk through this again, really high level. We talked about fix and flipping mortgage notes. How do we make money? So it really starts with acquiring those loans at a discount to the unpaid balance. And then, like we mentioned earlier, what motivates sellers? Some sellers will liquidate their undesirable loans. And when I say undesirable, I don't mean they're not good loans. They may just not fit their buy box. So it could have been, again, a second position lien, a lien in a state that they don't normally have servicing rights in, or a state that they're not familiar with. So liquidating those undesirables, making a quick penny on those is one way to make money. Richard, if you press next, yeah. So this is probably the bulk bread and butter of our business, is negotiating a payment schedule with the borrower. So again, really filling that gap, coming to terms with the borrower that makes sense for them to get back on track so that we can increase the value of the loan. If you press next, generate cash flow payments from those payments that they're making. And then the exit options there would be to sell the performing loan. The borrower would sell the home and pay off the loan, or refinance and pay off the loan. And right now what we're seeing is a majority of those fall into sell it as a performing loan. Again, because we've increased that value. And then the third option is taking ownership of the home. So we see this for about 5% or less of our portfolio, where people refuse to come to the table to work with us. They no longer want the property. There was a death, and so the family doesn't want the property. In that case, we will take ownership of the property and sell it back on the secondary market if it is not purchased at auction.
Okay. So we are coming up to Q&A shortly. So we've got a few more slides we want to get through, but please have your fingers at the ready for typing in Q&A as we're just kind of finishing this off here. One of the most important things here is risk mitigation and diligence. Is how do you guys do this to make sure that it's distressed in one sense of that, but distressed not in the other sense of the word? Is what's your process for mitigating this risk as much as possible?
So I want to touch on, there's two kind of risk mitigations here. There's risk mitigation on the assets, which I'll let Chris talk about. And then there's risk mitigation as an investor. So as an investor, something that's important to us is there's no additional leverage in what we do. I can't speak to other note funds, but for us specifically, we don't take on any additional leverage. So as an investor, when you talk about that capital stack, you're really first in line. There's no, we don't raise capital, go borrow from the bank to then buy more loans. It is investors are first in line. Now, when it comes to risk mitigation on the asset, like Chris will speak about here, hopefully very quickly as we have to get to Q&A, is that this is where the money is made, is really on the acquisition of the product. So I'll let Chris kind of go through a quick analysis of what we do there.
Yeah, just real quick is, the three main things we evaluate is the property, the borrower, and the situation. We get eyes on the property to make sure the property is not distressed, that it is a good looking property that is suitable and creates the valuation that we anticipate that it is. The borrower, is something we do a lot of due diligence on. And that includes, background checks. If the borrower has filed bankruptcy 5 times in the last 5 years, that would be somebody who we think knows how to, game the system pretty well. So that's very important. And then, like Lauren mentioned earlier, that situation component of, was it a job loss, a death of a family? Most people don't wake up one day and say, I'm going to stop paying my mortgage today. There's usually some underlying cause, and understanding that and seeing if that's something that can be resolved. Those are, the very, things we go very in depth with, along with, of course, understanding a title report, make sure the loan is secured, what position the loan is, and from that. And then we'll model that through many different exit scenarios to pinpoint a specific return. And as Lauren mentioned previously, we've done this, 700 times. So people can always models are always fine tuned to show, different things and between each type of asset. And one of the things that I'll just mention before I hit the next slide is, unlike traditional real estate, investing in debt is very different in the sense of each state has their own set of rules. So you own a house or you own a mortgage in New York is very different than a mortgage in Georgia, as an example. So understanding all of those rules and how to play by those rules is also extremely important as part of any due diligence.
Okay, and this again is, I think, another part of this risk mitigation is actually investments have equity already in them. So this is not 2007-8 where everything was 100% more. It was easy to walk away from.
Yeah. So if you take a property that today is worth $250,000, and a lot of strategies people will look at, including ours, is look at loans that are about 10 years old. This $250,000 property was probably $150,000 10 years ago, and they may have had a $125,000 loan. Well, today they've got that big equity bump, so it's worth $250,000, and it's a $75,000 balance. So it's a 30% loan to value. And then when you're also looking at buying these at a discount as well, like in this instance, it's just showing that $45,000 number, you can look at your equity coverage. And if there's a downturn in the market of any, it would have to be colossal to get down to that level, essentially. So there's so much equity in these assets, which, should equate to, people analyze as part of that risk profile.
Okay, and guys, please keep the Q&A coming as we're doing this. We'll someone's asked if they can review this. So yeah, we'll have a video available. We can send this to you as the presentation, or the recording is absolutely fine. So just for the last few minutes, and we'll address questions as they come in, but let's look at some real life case study. Yeah. Yep. So you guys talk us through this. This is, we've talked theoretical, let's actually get practical in real life here.
Yeah, so here's a property that was in Maine, and as you can, look at this property, clearly it's not a distressed property. The loan balance was just under $125,000 on a $500,000 property. The borrower was not making all their payments on time, so it kind of fell in between a category of what we listed as semi-performing, make some payments, but not all the payments. We acquired the loan for $80,000, and the borrower was renovating the property to sell because their significant other had passed away, and the house was, they didn't need a house for one person this big. They're actually moving down to Florida is what they wanted to do from Maine, which I think a lot of people end up doing. So we acquired that loan and sat and wait essentially to see what happened, and the loan got paid off and sold. So the borrower paid off the loan within from August to April, so in a very short time period, and all of that information was given to us is in that package that we knew all of this has happened. The lender knew this was happening, but they just didn't know or just didn't want to deal with it. So, and
again, is for me the difference between distressed and opportunistic is when you actually really dig into the circumstances that you can really get interesting acquisitions here.
Yep. So here's another, again, call it opportunistic opportunity, where there's a $350,000 house in Phoenix, which is been a booming market recently. They only owed $66,000 on the mortgage, and could acquire this loan for a little under $50,000. The borrower was not responsive, which is very common because they may, if anyone's missed a payment, you get 47 calls that first day, and then kind of they go away, or letters just get stuck in the trash and people ignore it. So demand letter from an attorney. Once people see law offices of XYZ, usually gets people to react a little more. And this caused the borrower to react and come to the table and understand that they didn't have to make all those payments up front because they thought they had to make all those payments at once. Like, no, we'll take a certain amount down and then let's work on an agreement where, basically got over $6,000. And then they agreed, hey, can I make double payments to get caught up? And they were ecstatic because they needed, they didn't have to come up with all the payments at once. And it also gave them, the opportunity to also pay all their other bills and work with them and create a win-win situation.
Okay, last one here.
Yep. And very similar to that last case study. This one, the little different twist is sometimes if the borrower doesn't have the money, we assisted them with some state program to get some of those funds. So here again, just under $250,000 property. The elderly woman owed $20,000 on the loan. It was sold non-performing. Was over a year behind. Significant discount, and the servicing company we use that assists these borrowers got them in contact with a home assistance fund program, which is a state entity. Especially during COVID, a lot of COVID relief. People also got relief from their mortgages, and worked with them. Got the borrower caught back up on all their payments, which included, over $11,000 in payments. And then we got that, rack that fix and flip. We fixed that loan, got it reperforming, held it for a little while, and then turned around and sold it off to somebody who had a self-directed IRA to get that cash flow and get those payments coming in.
Really good to see these kind of real world examples because people can relate to it. Okay, and we've answered a couple of questions as we were going there, but any last questions for anyone here? This will be available if you want a recording of this or the deck, let us know. And as we're wrapping up here, here's our details. Anything high level, alts, alts generic, please, there's my details, happy to speak. And then here's the details for Seveney to dig into this more. Reminder that either contact myself or whomever invited you if you want to log credits for this, and last chance for questions. But if not, then thank you very much for attending. Hopefully you not just got your credit, but actually learned something in an asset class that I didn't know that much about and actually find really interesting myself. Any last thoughts from you guys?
No, just like you said, I hope that looks like we have a question that came in.
Thank you.
Oh, love that. Thank you. Yeah, just thank you guys for attending, and like Richard said, hopefully you did learn something about an asset class that's not most people don't know about in practice, only in theory, or may not have heard that this is actually a thing. So I'm always happy to kind of expand, especially when it comes to alts and kind of demystifying them, I guess you could say.
Excellent. Well, pleasure presenting with you guys. Thanks everyone for attending. Thanks to Chris and Lauren, and have a great Christmas and holidays and everything, everyone. Thank you very much. Bye.
Thank you.
Thank you.